The auto industry has been actively engaged in the FASB and ISB's joint project on revenue recognition, as it could have a significant impact on the industry. The final standard was issued in May of 2014. Today's podcast will provide an overview of the standard and cover some industry-specific issues. My name is Brian Schilb, and I'm joined by Haley Krebs, and we are on the revenue recognition team in KPMG's Department of Professional Practice. So Haley, can you start by giving us some background on the new standard?
Sure, thanks Brian. The new standard has one core principle, which is that an entity recognizes revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. The new standard includes 5 steps, which are to identify the contracts with the customer, identify the performance obligations in the contract, determine the transaction price, allocate the transaction price to the performance obligations in the contract, and then recognize revenue when or as the entity satisfies a performance obligation. The issues specific to the automotive manufacturers really focuses on step 2, identifying the performance obligations in the contract.
So what are some of the issues that entities in the automotive manufacturing industry might need to consider when implementing the new guidance?
Well, the first issue is related to material rights for free or discounted products and services. Now, original equipment manufacturers, or OEMs, which is what the automotive manufacturers are considered, need to determine if they offer free or discounted products or services. These products or services can be implicit or explicit, and may be considered a material right held by either the OEM's customer, which is the dealer, or the dealer's customer, which is the ultimate consumer. If they are considered a separate performance obligation, a portion of the transaction price will be allocated and recognized as the material right is satisfied. Now, because vehicle prices can be significantly different due to various options offered, the transaction prices allocated to free products and services that are bundled with lower price vehicles could actually be higher than that for identical free products and services bundled with higher price vehicles due to the allocation on a relative standalone selling price basis. That may make it difficult to apply the allocation process across an entire vehicle product line. Another issue for automotive manufacturers is sales and marketing incentives. These incentives can be cash rebates, favorable financing terms, marketing incentives, or the free or discounted products and services that we mentioned before. Pre-sales incentives that are in the form of products or services and that are offered when the contract with the dealer is entered into will often be separate performance obligations. Post-sales incentives that are offered to the consumer, so these are ones that are made available to the consumer after the vehicles have already been sold to the dealer, will not be separate performance obligations. They will likely be cost accruals unless there is a valid dealer expectation that the incentives will be offered because the OEM has customary practices to do so. And that could be an implied performance obligation.
Okay. Switching gears, auto manufacturers often offer warranties with their vehicles. Will the treatment of the warranties be any different under the new standard than they are today?
Well, that depends. So your assurance type basic warranty is going to continue to be accounted for under a cost accrual method. But the OEM is going to need to evaluate whether its warranties provide a service in addition to that standard assurance. That could include extending the warranty period or providing coverage beyond fixing defects existing at the time of the sale. So, such as providing free maintenance to the end customer as long as that car is under the warranty, the basic warranty. Now, the service type component of that is going to be treated as a separate performance obligation, even if it's not separately priced in the contract. A portion of the transaction price will be allocated to those services and will be recognized when or as the service is provided. For separately priced warranty contracts, the current treatment under existing GAAP is to defer the stated contract amount and recognize straight line over the term, unless historical experience supports some other recognition. The new standard is going to require allocation of the revenue to an optional extended warranty and any product maintenance or service type component on a relative standalone selling price basis, which could be different than the contract amount under existing GAAP. Also, auto manufacturers currently are precluded from recognizing the sale of a vehicle if they guarantee its resale value. But under the new standard, if the manufacturer guarantees that when the customer sells the car at some point in the future, the auto manufacturer will pay the customer the difference between the sales proceeds and a guaranteed minimum resale value, then the manufacturer may recognize revenue for the original sale of the vehicle. It may also have a guarantee that needs to be accounted for in that case. However, if the auto manufacturer has the right or obligation to repurchase the vehicle at some point in the future, or if the customer has the right to sell it back to the manufacturer, then the manufacturer will need to consider the repurchase's guidance in the new standard. In these cases, the manufacturer cannot likely account for the original transaction as revenue.
So Haley, when will the new guidance be effective?
Well, the effective date for public business entities and certain not-for-profits is interim periods and years beginning after December 15th, 2016. So for a calendar year-end company, that is going to be effective starting on January 1st, 2017. For all other entities, they have a one-year deferral on that. Early adoption is not allowed for any company that's required to use the public business entity effective date, but the other entities are allowed to adopt at the earlier 2017 effective date. And I also did want to note that there are some significant additional new disclosures that are required under the new standard, including qualitative and quantitative disclosures for both interim and annual periods. There is some disclosure relief for entities that are not considered public business entities, though.
And upon adoption, how will an entity account for contracts in prior periods?
There are three different methods of implementing the new standard. So the full retrospective method, which is when the entity recasts all contracts for all prior periods presented, with a cumulative adjustment as of the beginning of the earliest period presented. So for a calendar year-end public business entity, that would be January 1st, 2015. They also have an option of doing the retrospective method using a practical expedient, of which there are a few offered. And the last option is a cumulative effect at the date of the adoption, which is recording a cumulative effect adjustment as of the beginning of the period adoption and not recasting any prior periods.
Well, thanks, Haley, and thanks to you, the listener. For additional information, refer to KPMG's Financial Reporting Network website, including the latest on the revenue recognition page, which links to KPMG analysis of the new standard, defining issues, webcasts, and other podcasts.